Welcome back to our deep dive summary of The Intelligent Investor by Benjamin Graham. If you've watched parts 1 and 2, you already know that Graham wasn't just teaching how to invest, he was teaching how to think. In part 1, we explored the mindset of the intelligent investor and learned from the legendary Mr. Market metaphor. In part 2, we dove into the difference between investing and speculation and discovered Graham's powerful rules for choosing quality stocks. But in part 3, we bring it all together. This is where you learn how to build a portfolio that lasts and that can grow with you through every market cycle. Let's get started. First, let's talk about investor types. Benjamin Graham believed that every investor falls into one of two categories: defensive or enterprising. The defensive investor is someone who wants low effort, low stress, and reasonable, stable returns. Their focus is on preserving capital. This type of investor doesn't try to beat the market. They simply want to match it safely. Graham recommends that defensive investors focus on a diversified mix of high-grade bonds and large-cap stocks or low-cost index funds. Now, the enterprising investor, on the other hand, is more active. They're willing to research, analyze, and dig deep into financial statements. Their goal is to outperform the market, not by taking wild risks, but through intelligent decision-making. Whichever path you choose, the rest of Graham's philosophy applies to both. Next up, asset allocation. This might be the most practical part of the book and the most timeless. Graham believed that no matter what's going on in the market, your portfolio should be balanced. He recommended a baseline of 50% in stocks and 50% in bonds. That split can change based on how the market behaves. But the key is to avoid emotional investing. If the market is booming and overvalued, you reduce your stock exposure. Maybe go 25% stocks, 75% bonds. If the market is crashing and everything is on sale, that's when you increase your stock exposure. Maybe 75% stocks, 25% bonds. This disciplined approach helps you do something most investors struggle with: buy low and sell high. Let's move on to one of Graham's most powerful insights: emotional control. He famously wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." And he's right. No matter how smart or experienced you are, emotions like fear and greed can ruin your financial decisions. We've all seen it: panic selling during a market crash, jumping into hype stocks, trying to time the market. Graham's solution: stick to your strategy, ignore the noise, and always focus on value, not price. He urges us to create an investing plan we can follow, especially during the most stressful times. That way, we don't fall into emotional traps when the market gets scary or exciting. Now, here's the big question: how do we apply Graham's principles today in a world full of crypto, AI stocks, and meme trades? The truth is, Graham's core ideas haven't aged at all. In fact, they've become even more important. For the defensive investor, today's version of his strategy might look like this: a portfolio of low-cost index funds like the S&P 500A bond ETF for stability, and maybe a little cash for flexibility. For the enterprising investor, it means doing your homework, analyzing a company's balance sheet, looking at earnings, debt, and valuation, finding companies that are temporarily undervalued, but fundamentally strong. You still use the margin of safety, you still avoid speculation, and most importantly, you still stick to the process, no matter what's trending on social media. Let's recap the key takeaways from part 3 of The Intelligent Investor. Know which type of investor you are: defensive or enterprising. Keep your portfolio balanced and adjust based on valuation, not emotion. Control your emotions and follow a written strategy. Focus on value, not hype. Always maintain a margin of safety, use modern tools, but follow timeless principles. Benjamin Graham wrote this book in 1949, yet his lessons still guide investors in 2025. That's because the core of investing hasn't changed. It's not about being the smartest, it's about being the most disciplined, and that is what makes someone an intelligent investor. Thank you for joining this 3-part journey. If you enjoyed this series, please like the video, subscribe to the channel, and share it with someone who wants to invest the smart way. And remember, Successful investing is not about making money fast. It's about making smart decisions over and over again. See you in the next video.